I want to tell you about the best day of my investing career. It was October 19th, 1987, Black Monday. The stock market crashed harder than it had since the Great Depression. The Dow Jones dropped over 22% in a single day. Billions of dollars of wealth vanished. People were panicking, selling everything they owned, convinced the world was ending. And you know what I did? I went shopping. While everyone else was running for the exits, I was looking for bargains. While people were crying about their losses, I was calculating which great businesses had just gone on sale that day, and the weeks that followed, I made some of the best investments of my life. Not because I'm smarter than everyone else, not because I can predict the future, but because I understood something that most people don't. Market crashes are not disasters. They're opportunities. Let me be clear about something right from the start. I'm not talking about being happy when people lose money. I'm not callous about the real pain that market crashes cause. But if you're a long-term investor, if you understand what you're doing, if you have cash available, then a market crash is the best thing that can happen to you. It's like your favorite store putting everything on sale. Would you be upset if prices got cut in half? Of course not. You'd be thrilled. That's how I think about market crashes. And that's what I'm going to teach you today. I'm going to tell you exactly what to do when stocks crash. Not just theory, but practical steps based on 7 decades of experience investing through every kind of market condition you can imagine. I've been through crashes, corrections, bear markets, recessions, financial crises, and everything in between. And I've made money through all of it by following a simple set of principles. Let me take you back to my first real experience with a market crash. It was 1962. I was 32 years old, running my investment partnership, and I thought I knew everything. The market had been great in the late 1950s and early 60s, and I'd been making good money for my partners. Then the market started falling. It dropped over 25% from peak to trough. I remember getting phone calls from worried partners. They wanted to know what I was doing, whether they should sell, whether their money was safe. And I told them the same thing I'm going to tell you today. When prices fall, that's when you want to buy more, not sell. The businesses we owned hadn't changed. They were still making good products, serving customers, generating profits. The only thing that had changed was the price. And lower prices meant better value. I spent 1962 buying stocks. American Express had a scandal with their commodity warehousing business, and the stock got hammered. Everyone thought the company was finished. But I looked at the situation and realized something important. The credit card business and traveler's check business, which were the real valuable parts of American Express, weren't affected at all. The company was fundamentally sound, but the stock was trading like it was going bankrupt. I bought heavily, not because I knew the stock would bounce back quickly. I didn't. I bought because the value was there. The business was worth far more than the stock price suggested. Over the following decades, that investment made my partners and later Berkshire Hathaway hundreds of millions of dollars. And it all started with a crash that scared everyone else away. That's the first thing you need to understand about market crashes. They create opportunities that don't exist in normal markets. When everything is going up and everyone is optimistic, good businesses trade at fair prices or premium prices. There are no bargains. But when the market crashes and panic sets in, good businesses get thrown out with the bad ones. Quality companies with strong fundamentals suddenly trade at prices that make no sense. That's when you make money. Now, let me tell you what most people do wrong when stocks crash. They panic. They see their portfolio value dropping day after day, and they can't stand it. They start thinking about all the money they're losing. They imagine it going to zero. They convince themselves they need to sell before things get worse. So they sell at the bottom, locking in their losses just before the market recovers. This is exactly backwards. Selling when stocks crash is the worst possible time to sell. You're selling at low prices, which means you're getting less for your investments than they're worth. You're selling when fear is highest and rationality is lowest. You're making an emotional decision rather than a logical one. And you're guaranteeing that you'll lose money. Let me contrast this with what you should do. When stocks crash, you should be buying, not selling. You should be excited, not scared. You should Be looking for opportunities, not running for safety. This is counterintuitive for most people. Their instinct is to flee when danger appears. But in investing, the time of greatest danger for most people is actually the time of greatest opportunity for those who know what they're doing. Here's a story that illustrates this perfectly. In 2008, we had the worst financial crisis since the Great Depression. Banks were failing. The stock market was in free fall. Everyone thought the entire financial system might collapse. It was genuinely scary, even for someone like me who'd been through many crises before. I remember calling the CEO of a major bank in September of 2008. Lehman Brothers had just collapsed. AIG was about to fail. Nobody knew which domino would fall next. The fear was palpable. And I asked him a simple question. If I gave you $5 billion today, what would you do with it? He told me he'd be buying stocks. He'd be buying his own bank stock and stocks of other good companies that had been beaten down by the panic. He knew the values were extraordinary. He knew the crisis would pass eventually. He just didn't have the capital to act on it. That conversation led to one of the best investments Berkshire Hathaway ever made. We invested $5 billion in Goldman Sachs, getting preferred shares that paid us a 10% annual dividend, plus warrants to buy common stock at a favorable price. The deal was structured so well that we made money even if things got worse. And when things got better, as they eventually did, we made a fortune. That investment happened because I was willing to buy when everyone else was selling. I was willing to be greedy when others were fearful, which is one of my most famous sayings. It's easy to say. It's much harder to do. When the world feels like it's ending, when CNBC is running nonstop crisis coverage, when your friends and family are telling you you're crazy, it takes discipline and conviction to buy stocks. But that's exactly what you should do. Let me walk you through the specific steps I take when stocks crash. This is my playbook, developed over 70 years and refined through countless market cycles. If you follow these steps, you'll not only survive market crashes, you'll profit from them. Step one is the most important, and it has to be done before the crash happens. You need to have cash available. This is crucial. If all your money is already invested when the market crashes, you can't buy anything. You're stuck watching opportunities pass by because you don't have dry powder to deploy. I always keep significant cash reserves at Berkshire Hathaway. Sometimes people criticize me for this. They say I'm being too conservative, that cash earns nothing and I should be fully invested. But cash gives me optionality. It gives me the ability to act when opportunities arise. And the best opportunities arise during crashes. Think about it this way. If you're at an auction and you've already spent all your money on the early lots, you can't bid on the great deals that come up later. But if you held back some cash, you can pounce when that perfect item comes up at a bargain price. The stock market works the same way. How much cash should you keep? That depends on your situation. For most individual investors, I'd suggest keeping at least 6 months of living expenses in cash for emergencies, and then whatever investment capital you can spare for buying opportunities. Don't keep so much cash that you miss out on years of market gains, but keep enough that when a crash comes, you can take advantage of it. Step two is to stay calm. This sounds simple, but it's incredibly hard in practice. When the market is crashing, your brain is screaming at you to do something. Your emotions are running high. You're seeing red in your portfolio every day. Your friends are panicking. The news is all doom and gloom. Every instinct tells you to sell and protect what you have left. You have to override those instincts. You have to remember that you're investing in businesses, not trading pieces of paper. Ask yourself, have the businesses you own fundamentally changed? If you own stock in Coca-Cola before the crash, are people suddenly going to stop drinking Coca-Cola? Of course not. The business is the same, only the stock price has changed. I use a mental trick that helps me stay calm during crashes. I imagine that I own an entire business, not just shares of stock. If I owned a private business, would I panic and sell it for half price just because someone offered me that? Would I accept 50 cents on the dollar for my valuable business just because the buyer was having a bad day? Absolutely not. I'd tell them to come back when they were thinking clearly. That's what a market crash is. It's the market having a bad day, or a bad month, or a bad year. but the underlying businesses haven't changed, at least not the good ones. So there's no reason to panic and sell. In fact, there's every reason to buy if you have cash available. Step 3 is to make a list of the stocks you wish you owned. I do this all the time, even when the market isn't crashing. I keep a mental list and sometimes a written list of great businesses that I'd love to own if the price was right. These are companies I understand with strong competitive positions, good management, and solid economics. The only problem is that they're usually too expensive. When a market crash comes, I pull out that list and start checking prices. Often, I'll find that some of those businesses are suddenly trading at attractive valuations. The crash has brought them into my buy zone. That's when I start acting. For example, I'd been watching Apple for years before we invested in it. I understood the business. I saw the ecosystem they'd built, the customer loyalty, the strong economics. But the stock always seemed fairly valued or overvalued. Then in 2016, there was a pullback. The stock dropped from around $130 to under $90. People were worried about iPhone sales slowing down. The concerns were overblown, and the price had come down to a level that made sense. We started buying, and it became one of Berkshire's best investments ever. The key is to have that list ready before the crash. You don't want to be trying to figure out what to buy when everything is falling apart. You want to have already done the research, already identified the businesses you want to own. Then when the crash brings the prices down, you just execute. You're not making emotional decisions in the heat of the moment. You're following a plan you made when you were thinking clearly. Step 4 is to focus on quality. This is critical. Not every stock that falls during a crash is a good buy. Some businesses are falling because they have real problems. They're over-leveraged, or their business model is broken, or they're facing obsolescence. Those companies might go bankrupt in a crisis. You don't want to catch those falling knives. What you want are high-quality businesses that are falling for no good reason other than general market panic. You want companies with strong balance sheets, consistent profitability, durable competitive advantages, and good management. These are businesses that will survive the crisis and thrive afterwards. During the 2008 financial crisis, I focused on companies like Goldman Sachs, General Electric, and later Bank of America. These were strong institutions that were facing a liquidity crisis, not a solvency crisis. They had good underlying businesses, but the panic was creating temporary problems. By providing capital when they needed it most, we got excellent terms and made enormous profits. Compare that to companies like Lehman Brothers or Bear Stearns. Those firms had fundamental problems. They were over-leveraged and making bad bets. When the crisis hit, they couldn't survive. If you'd tried to catch those falling knives, you'd have lost everything. The way to distinguish between quality companies temporarily down and bad companies deservedly down is to know the businesses before the crisis hits. If you've done your homework in advance, if you understand the fundamentals, then you can make good decisions when the crash comes. If you're trying to figure it out in the middle of the panic, you'll probably make mistakes. Step 5 is to buy in stages. Even when you've identified great businesses at attractive prices, you don't want to go all in at once. Why? Because you don't know if prices will go lower. The market might fall another 10 or 20 or 30%. If you spend all your cash early, you'll miss the even better opportunities that come later. I like to buy in tranches. I'll buy some shares at what seems like a good price. If the stock falls further, I'll buy more. Each purchase lowers my average cost and increases my position in a business I want to own. If the stock goes up instead, well, I'm making money on the shares I already bought, and I can deploy my remaining cash elsewhere. This approach takes the pressure off trying to time the bottom perfectly. You're not trying to catch the exact low point. You're just trying to buy good businesses at good prices, and you're dollar cost averaging your way in. Over time, if you're buying quality businesses, this works extremely well. Let me give you an example from my own investing. In 2011 and 2012, I was buying IBM. The stock was around $170 when I started buying. I bought more as it went up a bit, and then more when it pulled back. I accumulated a position over time rather than trying to make one perfect purchase. Now, IBM didn't work out as well as I'd hoped, but the approach was sound. I was building a position in what I thought was a good business at reasonable prices. Step 6, and this might surprise you, is to ignore the news. When stocks are crashing, the financial media goes into overdrive. They have 24-hour coverage of the crisis. They bring on experts to explain why everything is terrible and might get worse. They show you charts of the market falling off a cliff. They interview panicked investors and pessimistic analysts. All of this is useless noise. It's not information. It's entertainment designed to keep you watching. And it's dangerous because it amplifies your fear and makes you more likely to make bad decisions. I barely watch financial news even in normal times. During a crisis, I watch even less. Instead, I read annual reports. I study businesses. I think about valuations. I focus on fundamentals, not on what some talking head on TV thinks might happen next week. The news media's incentives are completely misaligned with yours. They make money from viewership, which means they want you scared and glued to the screen. You make money from good investment decisions, which means you need to be calm and rational. Those goals are in direct conflict. I remember during the 2008 crisis, every day brought new apocalyptic headlines. The financial system is collapsing. We're heading for another Great Depression. The world as we know it is ending. If you'd listened to that and sold your stocks in fear, you'd have locked in massive losses and missed the entire recovery that followed. Instead, I ignored the noise and focused on the signal. The signal was that good businesses were trading at absurd valuations. Banks with solid franchises were trading like they were going to zero. Insurance companies with good underwriting were priced for bankruptcy. Consumer companies with strong brands were available at huge discounts. The news was terrible, but the opportunities were extraordinary. Step 7 is to think long term. This is a theme that runs through everything I do, but it's especially important during market crashes. You have to remember that you're not buying stocks for next week or next month. You're buying businesses that you plan to own for years or decades. When I bought Coca-Cola in 1988, I wasn't thinking about what the stock would do in 1989. I was thinking about what the business would be worth in 2000 or 2010 or 2020. I was buying a piece of a business with a durable competitive advantage, and I was willing to hold it for as long as that advantage remained intact. That long-term perspective makes market crashes irrelevant. If you're planning to hold a stock for 20 years, what does it matter if it drops 20% next month? It doesn't. In fact, if you have cash available, it's a gift because you can buy more at better prices. Most people can't think this way. They're focused on short-term results. They check their portfolio every day. They worry about what will happen this quarter or this year. That short-term focus makes them vulnerable to panic during crashes. They can't see past the current crisis to the long-term value they're creating. I've held some stocks for decades. I bought Coca-Cola in 1988, and we still own it today, over 35 years later. I bought American Express in the 1960s, and we still own it. These long holding periods are possible because I bought quality businesses, and I wasn't shaken out during the inevitable crashes and corrections that happened along the way. Step 8 is to be patient. This ties into long-term thinking, but it's worth emphasizing separately. After you buy during a crash, the market doesn't immediately recover. Sometimes it takes weeks or months. Sometimes it takes years. You have to be willing to wait. I bought stocks during the 2008 financial crisis in late 2008 and early 2009. The market didn't bottom until March of 2009. Some of my purchases declined further before they recovered. But I didn't panic. I knew I'd bought good businesses at good prices. I just had to wait for the market to recognize the value. And eventually it did. The market recovered. The businesses I'd bought performed well. The investments made money, lots of money. But it required patience. If I'd sold in fear when my purchases initially went down, I'd have lost money instead of making it. Patience is hard, especially when you're watching your portfolio value decline. But it's essential. You have to believe in your analysis. You have to trust that you bought quality businesses at fair prices, and you have to give those investments time to work. Step 9 is to review your existing holdings. A market crash is a good time to honestly assess what you own. Some stocks you own might be falling because the market is panicking, but others might be falling because they have real problems. A. Crisis often exposes weaknesses in businesses that weren't obvious during good times. I look at each position and ask myself, would I buy this stock today at this price? If the answer is yes, I hold or even buy more. If the answer is no, I seriously consider selling and moving the money into better opportunities. A crash creates a reset point where you can reevaluate everything without the bias of your original purchase price. For example, during the 2008 crisis, I looked at all of Berkshire's holdings and asked whether each business would survive and thrive. Most would. They were quality businesses with strong balance sheets and good economics. But a few looked shakier. In those cases, I had to make tough decisions about whether to hold on or cut losses and move on. The key is to be honest with yourself. Don't hold on to a declining stock just because you don't want to admit you made a mistake. Don't fall victim to the sunk cost fallacy. Be willing to acknowledge when you were wrong and move your capital to better opportunities. Step 10, and this is the last one, is to stay invested. Even if you don't have cash to buy more during a crash, even if you're fully invested, you need to resist the urge to sell and go to cash. Staying invested is crucial because the biggest gains often come right after the biggest losses. The stock market's best days are usually closely clustered with its worst days. If you sell during a crash to avoid more losses, you'll likely miss the recovery. And missing just a few of the best days can dramatically reduce your long-term returns. There's a study that shows if you'd invested in the S&P 500 from 1993 to 2013 and stayed invested the whole time, you'd have made about 9.2% annually. But if you'd missed just the 10 best days during that 20-year period, your return would have dropped to about 5.4%. Miss the 20 best days and you'd have made only 3%. Miss the 30 best days and you'd have actually lost money. The point is, you can't time the market. You can't sell during crashes and then magically get back in at the perfect moment for the recovery. Nobody can do that consistently. The best strategy is to stay invested in quality businesses through the ups and downs. Now, let me address something that might be bothering you. You might be thinking, Warren, this all sounds great, but I'm not you. I don't have billions of dollars. I don't have your experience. I don't know how to analyze businesses like you do. How can I follow this advice? Here's the truth. You don't need to be me to follow these principles. You don't need billions of dollars. You need some cash reserves and the discipline to use them during crashes. You don't need decades of experience. You need to focus on businesses you understand, which might be different from the businesses I understand. You don't need to be an expert analyst. You need to invest in quality and avoid junk. If you're not comfortable picking individual stocks, you can buy index funds. An S&P 500 index fund gives you ownership in 500 of America's best businesses. When the market crashes and the index falls, you're buying all 500 of those businesses at lower prices. You don't need to pick the winners. You own them all. The key is to have cash available and the courage to invest it when prices are low. If you can do that, if you can buy index funds when they're down 20 or 30 or 40%, you'll make money over time. It's almost mathematically certain. Let me tell you about one more crash because this one is recent and instructive. In March of 2020, when COVID hit and the world shut down, the stock market crashed hard. In just a few weeks, the S&P 500 fell over 30%. It was fast and scary. Nobody knew how bad COVID would be or how long the shutdowns would last. I watched that crash with great interest. We made some investments, though I'll admit I wish we'd made more. The market recovered so quickly that the opportunity was brief. But the lesson was the same as always. When quality businesses go on sale, you buy them. People who panicked and sold in March of 2020 locked in their losses. People who stayed invested or bought more made their money back and then some. The market not only recovered all its losses, it went on to make new highs. And it happened faster than anyone expected. That's why you can't time these things. You can't try to sell at the top and buy at the bottom. The best approach is to stay invested in quality businesses, keep some cash for opportunities, and buy more when crashes bring prices down. Let me share one final thought with you. Market crashes are inevitable. They're part of investing. If you're going to be in the stock market, you're going to experience crashes. The question is not whether crashes will happen, but how you'll respond when they do. Most people respond poorly. They panic, they sell, they make emotional decisions that cost them money. A small percentage of people respond well. They stay calm, they buy quality businesses at attractive prices, and they make money from the crash. Which type of person do you want to be? The choice is yours, but I'll tell you, it's a lot more profitable to be in the second group. The irony is that market crashes create the best investment opportunities, yet most people treat them as disasters to be avoided. They have it exactly backwards. Bull markets, when everything is expensive and everyone is optimistic, those are dangerous times. You're paying high prices for mediocre prospects. Bear markets and crashes, when prices are low and everyone is pessimistic, those are opportunity times. You're paying low prices for good prospects. I've made more money from market crashes than from bull markets. Not because I'm clever or lucky, but because I follow the principles I've outlined today. I keep cash for opportunities. I stay calm when others panic. I buy quality businesses at attractive prices. I think long term. I'm patient, and I stay invested. These aren't complicated principles. They're simple, common sense ideas. But simple doesn't mean easy. It takes discipline to follow through, especially when your emotions are screaming at you to do the opposite. I've been investing since I was 11 years old. I've been through more market cycles than I can count. And I can tell you with complete certainty that the next crash is coming. I don't know when. I don't know what will cause it. I don't know how severe it will be, but I know it's coming because crashes always come eventually. When that next crash arrives, most people will panic. They'll sell in fear. They'll make emotional decisions that destroy their wealth. But you don't have to be like most people. You can be prepared. You can be calm. You can be opportunistic. You can buy when others are selling and make a fortune in the process. That's what I've done my entire career. That's what I'll continue to do for as long as I'm investing. And that's what I'm encouraging you to do. Don't fear market crashes. Welcome them. They're opportunities in disguise. They're sales on quality businesses. They're your chance to buy assets at prices that won't be available in normal markets. So when the next crash comes, and it will come, remember what I've told you today. Keep cash available. Stay calm. Make a list of quality businesses you want to own. Focus on companies with strong fundamentals. Buy in stages. Ignore the media noise. Think long term. Be patient. Review your holdings honestly and stay invested. If you do these things, you won't just survive the next crash. You'll profit from it. You'll look back years later and recognize it as one of the best investment opportunities of your life. That's how I think about every crash I've been through. They weren't disasters. They were opportunities. And the next one will be too. The stock market is a device for transferring money from the impatient to the patient. Crashes accelerate that transfer. They separate the weak hands from the strong hands. They reward those who can control their emotions and punish those who can't. Make sure you're on the right side of that equation. I've given you my playbook. I've shared the lessons I've learned over 70 years and countless market crashes. The rest is up to you. Will you panic when the next crash comes, or will you profit? Will you sell in fear, or will you buy with conviction? Will you be like most people, or will you be an intelligent investor? The choice is yours. But I know which choice leads to wealth and which choice leads to regret. I've seen it play out over and over again throughout my career. The people who stay calm and buy during crashes end up rich. The people who panic and sell end up poor. It's that simple. So always do this when stocks crash. Buy quality businesses at attractive prices and have the patience to hold them until the market recognizes their value. That's the secret. That's how you make money in this business. And that's how you turn market disasters into personal fortunes.